Okay, grazie. Welcome to the Commission's press room. Today is Wednesday, the 12th of May. As you have noticed, we had to anticipate this press conference by half an hour. We're starting a bit earlier. Apologies for the change in schedule. Let me also tell you that the embargo is lifted at this time because we had indicated initially a different embargo time, but you consider it lifted now as we're starting the press conference. We're here for a press conference on the Commission's Spring 2021 economic forecast, and we have with us Commissioner Gentiloni. Commissioner, the floor is yours.
Thank you. Thank you, and good morning to everyone. Well, beginning with the key messages emerging from this forecast, and we have five key messages. First, the EU economy is set to grow robustly this year and next. The resurgence of the pandemic and the need to tighten health-related restriction resulted in a weak start to the year. But the faster pace of vaccinations in recent months should allow restriction to be eased further in the second half of the year. And in fact, this is already happening, and thereby allow the economy to bounce back. Overall, the EU economy is forecast to grow by 4.2% in 21 and to strengthen to around 4.4% in 22. In the euro area, the GDP will grow at 4.3% this year and 4.4% next year. This is a brighter outlook than expected in the winter forecast, and this is due to two main factors. First, a stronger than previously expected rebound in global activity and trade. And second, and not least, the growth impulse coming from the integration in the forecast of the initial boost of our Recovery and Resilience Fund. Second key message, employment is expected to grow next year and unemployment to decline, while government support schemes, including the EU-backed SURE program, have prevented unemployment rates from rising dramatically. Labor markets will take time to fully recover. And we know that youth unemployment has risen more than for the labor force as a whole. In short, the risk of scarring with a worsening of poverty, social exclusion, and inequality is very real. And when we present overall positive estimates and forecasts, we should not forget this. Third, first, fiscal measures have sheltered the economy and paved the way for the recovery. In this context, significant EU expenditures are assumed to be financed by grants from the RRF. The cumulative impact of EU GDP over the 2022 period is estimated in this forecast at 1.2 of the EU 2019 real GDP. So this is the impact until 22 of RRF grants. Fourth, inflation is set to peak this year under the impact of some transitory factors. However, it is set to moderate again in 2022. And fifth, the uncertainty surrounding the outlook will remain elevated. Overall, the risks which are related to both epidemiological and economic factors are considered to be broadly balanced. So Europe lived through a third wave of the pandemic early this year, as I told before. After a slow start, vaccination campaign have accelerated significantly. Common procurement and distribution proved to be the right thing to do. This progress should lead to a steadily more marked fall in infections. To date, on average, in the EU, more than 76% of people aged 80 years and above have received at least one vaccine dose, and more than half are fully vaccinated. Going forward, our assumption is that the pandemic will evolve in a way that allows for restriction to be marginally eased in the course of the second quarter, and we are already observing such steps in several member states. The global outlook, it has improved considerably for both advanced and emerging market economies. After somewhat stronger than expected growth last year, the global economy continued the positive momentum early this year as restrictive measures were loosened and aggressive policy support was put in place, especially in advanced economies. Then we know there are exceptions. For example, we all look to India and worried about the situation and with solidarity with suffering people, but the global GDP, excluding the EU, is expected to grow by 5.9% in 21 and 4.2% in 22. Amid the solid expansion in global trade, EU export markets are thus set to increase by 8.3% in 21 and 6.4% in 22. And this increase in EU export market is part of the strength of the possible growth that we estimate. Countries and regions are expected to recover at varying rates, due also to the different strength of the pandemic around the world. So we have differences at global level, national level, and sectorial levels in the recovery and in its speed. The prospects for the US recovery have improved significantly, notably in 21. This reflects both progress in vaccinations and the two large fiscal packages adopted in late 20 and early 21. More robust US growth is expected to create positive spillovers for the global economy. For the EU, the estimated benefit is a cumulative boost of about 0.5 percentage points in 21-22. I mean the impact of the US robust growth. In China, growth is set to continue at a rapid pace, aided by its early control of the pandemic and buoyant external demand. It's important to keep this international perspective in mind when we assess the improved outlook of the European economy. Elsewhere, many emerging and developing economies are in a more challenging situation, and the low-income countries are in a very difficult situation, with difficult access to vaccines and limited policy space weighing on their growth prospects. The EU economy, it faced another setback in late 2020 as the resurgence of the pandemic prompted a new round of containment measures, as we all know, with output falling again in the last quarter of 2020 and the first of 21 by a cumulative 0.9%. So the EU was pushed back in a technical recession. However, the EU economy is set to rebound strongly this year and next. The latest Commission survey suggests this. As vaccinations accelerate, containment measures are set to be progressively lifted, allowing the economy to rebound this quarter and even more so during the third quarter as the impact of the RRF also kicks in. Growth is then forecast to remain solid in the last quarter of 21. Private consumption will be the main growth engine, and not surprisingly, as household spending benefits from dissipating uncertainty and some households start to spend more and save less once restrictions are eased. An improved outlook at home and abroad is expected to propel investment. a continuation of favorable financing conditions, recovering profitability among firms, and increasing capacity utilization rates all push in the same direction. These tailwinds are likely to be strongly reinforced by the support for public and private investment through the RRF. The EU public investment to GDP ratio is forecast to rise to almost 3.5% in 2022, up from 3% in 2019. This will be its highest figure since 2010. Finally, the strong rebound in EU's major trading partners is likely to have a positive impact in our export, particularly for merchandise export, while the recovery of services export, such as tourism, is set to take longer. Will be there, but it will take longer to recover. Economic activity in the EU is now projected to recover to its pre-crisis level in the fourth quarter of 2021. In the euro area, this threshold should be crossed in the first quarter of 2022. Still, the economy will remain below its pre-crisis trend, illustrated here by the autumn 2019 forecast prepared before the outbreak of the health crisis. The risks of scaring effect remains real and underlines the ongoing importance of appropriately targeted supportive policies. This need is, of course, still there. Next Generation EU is an unprecedented boost to the EU economy. And for the first time here, we incorporate the impact, part of the impact of the RRF on all member states. The amount of expenditures and other costs financed by RRF grants included in this forecast varies quite a lot across member states. This reflects their difference in RRF allocation and the assumed absorption profiles. Overall, the total EU expenditure assumed to be financed by RRF grants amount to 62 billion euro in 21 and 77 billion in 22. Cumulatively, this is around 40% of the total RRF grant allocation. The lifetime of this allocation extends until 26. This implies that on average, member states count on fast absorption of their RRF allocation, 40%, as I said. With a horizon of less than 2 years, this forecast could assess only the RRF immediate and direct impact on GDP from increased domestic demand. So it could only partially capture the indirect effects that will be there. Overall, as I said, the RRF is expected to boost EU GDP by approximately 1.2% of the EU 2019 real GDP over the period 2022. After shrinking last year, all EU economies are forecast to join the recovery this year and grow strongly in 22. But as we have been warning for some time, just as the depth of the recession was varied widely, so too will the speed of the recovery. So differentiation will be there. Still, all the EU economies are now forecast to reach or surpass their pre-pandemic GDP levels by the end of 22 at the latest, but not the previously estimated trends, as I said. A few words on the largest economies. Germany's GDP contracted by 1.7 in the first quarter, but the lifting of restrictions and the ongoing strength of exports are expected to see GDP recover to its pre-crisis level towards the end of this year. Growth is projected at 3.4% in 21 and 4.1% in 22. In France, economic activity is forecast to rebound by 5.7% this year. After a slight contraction in the second quarter of 21, GDP is expected to bounce back in the second half of the year as restrictions are eased. And in 22, the National Recovery Plan is set to support GDP growth, which is forecast at 4.2 overall. GDP is forecast to reach its pre-crisis level at the beginning of 22. For Italy, real GDP is projected to increase by 4.2% this year and 4.4% next year. After a strong rebound in the second half of this year, the economy is set to embark on a sustained expansion path, which should allow output to return to its pre-pandemic level by the end of 22. RRF-supported investments and reforms will, of course, play an important role in sustaining the recovery. And finally, in Spain, real GDP is projected to grow by 5.9% in 21 and 6.8% in 22. And its GDP is expected to return to its pre-pandemic level also by the end of 22. The implementation of the recovery plan will play a decisive role, driving the rebound this year and more strongly in 2022. Finally, in Poland, after one of the shallowest recessions in the EU, the economy is expected to grow by 4% this year and 5.4% in 22. And the RRF is expected to take full effect and propel growth next year in 22. The magnitude of fiscal measures that were taken also in consequences of European decisions that were taken is expected to reach around 4% of GDP in both 20 and 21 in the EU as a whole. These include spending on healthcare as well as temporary support to households and businesses to shield them against income losses, to protect employment, and to avoid a surge in insolvencies during the acute phase of the pandemic. Next year, as governments should be able, we hope, to start phasing out emergency support, remaining measures are expected to amount to around 1% of GDP. Fiscal policy in the EU is then expected to remain supportive, also thanks to the support from the expected acceleration in spending financed by RRF that I referred earlier. Such massive public support contributed to an increase in the aggregate budget deficit in the EU from 0.5% of GDP in 2019 to around 7% in 20, and is set to increase further this year to 7.5% of GDP. A similar evolution is set for the euro area in 22, thanks to the continued recovery and the phasing out of much of the policy support. The deficits in the EU and in the euro area are both expected to halve to 3.7% and 3.8% of GDP. So growth in 21, also in relation to 2020, and reduction in 22. Let me stress once again that without the decisive policy actions to contain the pandemic and limit its economic fallout, the long-term budgetary impact of the crisis would be far worse. So I think that those decisions were the right decisions to take. In 21, only two countries, Denmark and Luxembourg, are projected to run a deficit of less than 3% of GDP. In 22, 15 member states are forecast to still register a deficit greater than 3% of GDP. As far as the debt is concerned, This year, the debt to GDP ratios are projected to peak at around 95 and 102% in the EU and the euro area, respectively. So the peak year will be this year, before decreasing slightly in 2022. The debt to GDP ratio is expected to remain over 100% in 7 member states: France, Italy, Spain, Belgium, Greece, Cyprus, and Portugal, up from 3 at the end of 2019. The labor market. The widespread use of job retention schemes across member states has enabled many employees to hold on their jobs. Labor market conditions slowly started to improve in the second half of last year. Many people returned to the labor force, and many workers no longer needed short-time work schemes. Forward-looking indicators have also improved markedly this year. However, labor markets will take time to fully recover, as there is scope for working hours to increase before companies need to start hiring again. While the unemployment rate in the EU has only increased slightly since last year, it is set to rise further this year. Then, next year, in 2022, as headcount employment is expected to start rising again, the unemployment rate should decline in 2022 to around 7%, slightly more than the 6.7% rate before the pandemic. It is important to highlight that the labor market outlook hinges not only on the speed of the recovery, but also on the timing of policy support withdrawal and the pace at which workers are reallocated across sectors and firms. The Commission therefore continues to call for such national support measures to be phased out gradually and thoughtfully. And here we are with the inflation, the rising energy prices, positive base effects, and a host of temporary factors have pushed headline inflation up this year. These factors will continue to shape the profile of inflation this year, but should wear off gradually in 2022. Other factors should broadly offset. On one hand, the strong recovery in demand and some supply-side constraints, such as in transport, are set to push inflation up. On the other hand, the remaining slack in the economy is expected to keep underlying inflationary pressures muted. Overall, inflation in the EU is expected to increase from 0.7% in 2020 to 1.9% this year, and to moderate to 1.5% in 2022. In the euro area, it is forecast to moderate from 1.7% this year to 1.3% in 2022. So the risks surrounding the GDP forecasts are still high and will remain so as long as the pandemic hangs over the economy. On the epidemiological front, developments concerning the pandemic and the efficiency and effectiveness of vaccination programs could turn out better or worse than assumed in our central scenario. On the economic side, the upsides could come from stronger global growth, particularly in the US, and this would have a more positive impact on the European economy than expected. Also, household willingness to spend, a key factor already in this forecast, could turn out higher than projected. And this is the upside risk. On the downside, the premature withdrawal of policy support could jeopardize the recovery. Also, the impact of corporate financial distress on the labor market and the financial sector could prove worse than anticipated. But overall, the risks surrounding the outlook are broadly balanced. And you may remember that in the previous forecast, the downside risks were clearly prevailing in relation to the upside risk. Now they are broadly balanced in our estimate. So in conclusion, for a year we have been presenting forecasts that were very negative. Today, for the first time since the pandemic hit, we see some optimism prevailing over uncertainty. That uncertainty is, of course, still there, and we should never forget this. But recovery is no longer a mirage. It is underway. We must avoid mistakes that could undermine it, namely a premature withdrawal of policy support. The quality, the strength, and the duration of the recovery could still be influenced by the pandemic, but our economic fate is primarily in our own hands. And that is why we need to roll up our sleeves. Thank you, and I am looking forward to your questions.